Hey guys, Stock Saturday, and it's been a reasonably good week. About 6.1% up, pretty good. Looking at the markets, even the FTSE 100 is up 3.11%, so fair enough. Everyone, I guess, is doing reasonably well. Nasdaq up 4.12%, and the S&P is up 3.71, so narrowly outperforming the FTSE 100 for once, only narrowly. Um, sort of gains this week have largely come from the crypto side. No sort of super surprises there. I've had sort of some reasonable gainers in Himax and TSMC doing quite well, above 20,000 position now, looking rather good. Applied Materials looking pretty solid as well. No sort of super surprises there. Semi-industry does seem to be ramping up. Intel sort of shooting up on buyout rumours, which I think could be quelling down fairly soon. I never like sort of, stock going up on rumours of buys that likely aren't going to happen. So, yeah. Cash, you might notice, is a little bit lower than last week. Made some acquisitions in Ingredient, BlackRock, CME Group, and a little bit into Evolution. Sort of saw a bit of a bear case on Evolution in that, yes, they're making money, but they're making an awful lot of money from the unregulated market, and sort of maybe even more than the regulators are going after them for, and sort of suggesting that we should be valuing Evolution on the properly regulated business only, in which case you find they're at about sort of 25 to 30 times earnings, which, I mean, to be honest, may not be the worst thing in the world for the sort of profit that they generate. I'm guessing the profit would be a lot lower on the regulated markets only, but yeah, the stock, I suppose, would drop a reasonable amount, but we'd have to sort of reevaluate them again and see. I can't imagine they're going to lose all of the unregulated market overnight, but certainly seems to be something that people are going to be going after, and we shouldn't just be looking at them and saying it's 12 times earnings for a 60% margin business, because some of it potentially is illegal. But we'll have to see. We did start to have earnings come out. So TSMC, as always, sort of go first with they go straight in with their balance sheet on first page, all looking rather nice. $1.88 trillion last quarter in cash, up to 2.127 trillion new Taiwan dollars, and a little bit in marketable financial instruments as well. Yeah, long-term property, plant and equipment side up about 163 billion Taiwan dollars. So that's pretty good. More fabs coming online. Part of the CHIPS Act sort of kicking in as well, maybe. And not a lot of this coming from debt. Bonds payable up from 909 billion to 926. So, yeah, what is that? 16, 17 billion in debt, and sort of, 240 billion in cash increase. So, very, very nice. Current portion of debt as well, up 1 billion. So, tiny, tiny numbers. These obviously are all Taiwan dollars, so you sort of divide by about 30, 31 at the moment, and they do give you the USD value on the left here, not on previous quarters. But yeah, it's looking rather nice on the balance sheet. Income statement wise, looks even better. You sort of could be forgiven for being very happy with, these this quarter numbers if this was last year, but this is third quarter 2024. Revenue up 14% to 868 billion. Expenses only up 11.2%, so that's pretty good. On the year, it's 38.8% up on revenue, 21% up on cost of revenue. and yeah, R&D sort of increasing, sales general increasing, not as much as revenue. On the year, sales general and administrative is up 37%. Not quite so much this quarter, but yeah, overall it's looking very strong and leading to much higher margin. They do have obviously net interest income, having all of that cash compared to not a huge amount of debt. So yeah, this quarter last year, they made 14.5 billion in interest, and this year they're looking at 21.7 billion, or 673 million US dollars. So yeah, nice, little bit extra to add to net profit. And speaking of net profit, up from 325 billion to 374 billion, 15% up and 57% up on last quarter of 238. So very, very nice. And yeah, weighted average shares, they don't do buybacks or much dilution at all. So average shares is exactly the same as last year. Looking at the presentation as well, everything looking rather nice. Revenue was sort of top end of guidance, 26.1 to 26.9. It was 26.88. So very nice. Gross margin was the high end of their estimates. Operating margin was slightly above the high end of their estimates. And yeah, 43.1% net profit, which for a manufacturing company is pretty outstanding. I would have thought one of the highest in the world as far as sort of large scale multi-billion-dollar companies go. By technology, they sort of show you, as expected, 3 nanometer is growing very, very nicely. Should, I would have thought, overtake 5 nanometer, sort of probably not this quarter, but maybe Q2. Looking good. 7 nanometer sort of shrinking down slightly from last quarter. This will give you the comparison with 2023. So 7 nanometer down slightly. 5 nanometer slightly up, I guess, taking a little bit of share from that, and sort of the smaller ones dropping down a little. And yeah, 3 nanometer up from 6% to 18%. So very, very nice. Apple obviously get the newest first dibs on the newest stuff, so not too bad. On the fourth quarter, you can see this is largely coming from high performance computing, your Nvidias and all the rest of that. 17% from smartphones, pretty good. Internet of Things, your smart fridge. No one wants a smart fridge from the looks of it. Automotive 6% up, and consumer electronics down a little. For the whole of 2024, it's, you can really see that Nvidia money starting to trickle in. You got sort of others as well, obviously Broadcom, AMD, some of the Chinese as well, sort of MediaTek and Koreans. So yeah, it's high performance computing. Smartphone obviously doing really well, 23% up year on year, and then all of those sort of Internet of Things, automotive, consumer electronics, just doing low single digits year on year. Others sort of, is only 2% anyway, but that was down a reasonable amount. We've sort of seen the balance sheet. Looking at guidance, first quarter being 25.0 to 25.8 billion. Yeah, slightly down on the sort of 26.8. This quarter, first quarter is sort of normally a little bit quieter than last quarter. So yeah, guidance being almost the same as Q4 was pretty strong, I thought, and basically the same gross profit and operating profit. So very nice. Not a lot of recent major events. They sort of sell you, anything that's happened maybe since the end of these earnings were produced, end of sort of Q4. Yeah, not a lot. Approved a dividend. Never sort of all that much bothered by the dividend, to be honest. It's nice to receive, but I would sort of prefer expanding fabs and, ploughing it back into the company, basically. And then BlackRock. Why am I buying BlackRock? So they go fairly early on earnings, it's looking like, and we've got a very nice little sort of half a page from Lawrence D. Fink, Mr. Larry, and yeah, BlackRock assets under management up to 11.6 trillion. He's sort of noting 641 billion in net inflows in 2024. The rest of the gain is obviously gains on the stocks themselves, and well, probably not on the fixed income side. They are pushing forward with acquisitions, acquisition of GIP, planned acquisitions of HPS and Preqin, all sort of private credit, moving further into their private credit business, sort of lending out money rather than just holding assets for people. So that was interesting. HPS Investment Partners, creating an integrated private credit franchise with 220 billion in pro forma client assets. So interesting, moving sort of beyond, as I say, just holding assets for people, and they see this as a lucrative area to get into. I've heard a lot of companies sort of that maybe had a lot of debt and sort of refinance that debt, during the COVID times, and are now sort of, having it come up for renewal, going from 1% debt, or back when rates were 1% debt, they maybe had 3 or 4%, debt from the banks. They would now be rolling it over to 7, 8, 9%, and they're choosing instead to sort of roll that over short term with private credit firms, hoping that rates maybe come down. I wouldn't bet on that, to be honest, but it seems sort of reasonably good business, and BlackRock sort of looking to get into this, so we'll see. As you say, assets under management up from 10, well, bang on 10 trillion really, to 11.5 trillion, up 15%. It's very, very nice. And revenue up 23% on those assets from Q4 last year. So very nice, $5.67 billion. Operating margin 36% on that, and net profit sort of 29.5%, almost the 30% that I do like. Net profit up 21% from this quarter last year. So very, very nice. Dilution up slightly to fund these acquisitions, of course. 5%, up on shares outstanding, but I think that will obviously the gain from that will start to show in the next sort of few quarters. I think their presentation sort of shows off a little bit more of the business as well than just the hard numbers. Obviously, I enjoyed going through the numbers, but some of these graphs sort of give you a nice indication into where the money comes from, really. So 54% of their assets are from institutions, only 9% in sort of direct retail investment, and then people investing in the ETFs as well. Some of that will be obviously retail in the sort of iShares core, America index or world index or whatever. And then sort of that's assets under management. What actually drives the fees is a little bit different. So they have a lot of active, thematic ETFs, your sort of iShares green energy and that sort of thing. Much higher fee than the passive stuff, and it looks like retail sort of go for a lot of that. Retail make up 9% of assets under management, but drive 25% of the fees. Institutions obviously sort of going for much cheaper stuff, and sort of directly investing with BlackRock at a lower rate. Active is 25% of their offering, index sort of being 30%, and ETFs 37%, a little bit of cash as well. And again, sort of on the fee side, obviously the active is what drives more of the fees. Some of the active ETFs can be 6, 7, 8 times the expense ratio of a passive index. So that's where a lot of the money comes from. Obviously, people are switching to index funds over time, and you sort of see this indexed amount, this 30%, is only 7% of fees. So potentially, as we move more and more into indexes, this 45% could dwindle down, and you may not get sort of quite so much strong growth, but we'll have to see. Product type, equities, obviously the largest portion, 55%. Fixed income is 25%. Multi-asset as 8%. Alternatives, 4%. They do seem to be pushing more into alternatives. And then a little bit of cash. So by fees, it's not all that much different, really, aside from alternatives driving an awful lot of these fees. So people wanting to be in a little bit more than just equities and fixed income, and they're kind of charging you for that 16% of fees, where it's only 4% of assets under management. And yeah, by region is sort of the least difference, really. Europe, Middle East, and Africa sort of make up 24% of AUM, but that's 28% of fees. I don't think you can take too much from that. Asia sort of being the smallest part, and then America is just over 2/3 of everything, basically. You can see profit sort of going up. I like this sort of quarterly one as well, not just comparing to last quarter, but you can see sort of profits steadily trickling up. 41.2% operating margin in Q4 2022, a couple of years ago, up to 45.5% in the most recent quarter, down slightly from last quarter. And yeah, net income sort of obviously on the way up, but it's nice to see margin sort of going up as well, not just the profit itself. And their share repurchases, as I say, sort of doing buybacks and things, 151.8 million, sort of trickling down and down and down, and then obviously they do these acquisitions. I expect they'll sort of be digesting those and starting to buy back shares again. You can see sort of 375 million a quarter, fairly consistently, with some bigger quarters on share repurchases, and a sort of fairly steady dividend, sort of fairly slow growing dividend. And so this alternatives section was quite interesting, sort of very fast growing. Client assets up 40% on this quarter last year, largely driven by sort of infrastructure. Quite interesting. Private equity, private credit, sort of all growing. I'm not sure whether their new acquisitions will be sort of coming into this section, or whether they'll count it somewhere else. But yeah, certainly alternatives. This is quite high fee paying, and yeah, not all of it is fee paying, but it's certainly rising. Multi-alternatives, so people sort of do seem to be not all that happy with just having this 60-40 portfolio of equities and bonds. So pushing more into this real estate, private credit, and liquid alternatives. I'm not sure whether they count their crypto in here, or whether it is just in ETFs. I'm guessing they would probably call it an alternative. But yeah, you got many tens of billions now in the crypto ETFs. So maybe they'll sort of stick that in a multi-asset and start having more inflows into that. But yeah, overall, I really like it as a sort of toll taker, basically, chipping a little bit off sort of all of the assets in the world, basically, or all of the liquid assets in the world. Yeah, lovely stuff. So economic news, we didn't really have a huge amount this week. PPI in the US, producer price index, sort of quite a bit lower than, it's not worse, that's better. Red number doesn't always mean worse. Sort of a leading indicator potentially of inflation. And we had UK inflation quite a bit lower than expected. That's pretty good, 3.2% core year on year, sort of down from 3.5% last month. Good to finally see a little bit of respite. Similarly on the US, everyone got really excited about this, 3.2% year on year core inflation. Headline was the same, up from last month, admittedly, but they obviously focus on core. Thursday, you sort of had jobless claims still looking very, very strong. People still saying unemployment's going to go up from what is 4.3% at the moment to 6%, as if it's inevitable. But certainly doesn't seem to be happening at the moment. And core or retail sales in the UK looking quite a bit weaker than expected, but I think some people are sort of making a bit of a meal out of this. You look at the sort of trend for the last 2 years, it's pretty much consistently up. So yeah, maybe people got a little bit too excited thinking it was going to be amazing. It's not, but it's still looking up. And portfolio-wise, as I say, it's the crypto sort of largely helping the portfolio along here. CleanSpark, Riot, and Hive, in that order, basically, which you'd sort of think is quite good, really, since that would sort of be the order of efficiency and actually doing, quite well out of the mining. But yeah, CleanSpark sort of, I think, up about 18% for the week. Riot up about 11%, and then Hive only 7%. They need to push on a little bit more. Gold and silver sort of not doing quite that well, considering gold sort of pushing up to 27.50. Silver doing quite well as well. I think we sort of need to see the Q4 earnings and sort of get some guidance maybe, but they must be making money at these prices, especially sort of Equinox with their new mine. So I'm keen to see the earnings. Not really seen much change in the Pan American and KGHM side. And yeah, on the option side, there's been a little bit of activity. Himax sort of doing really well this week. I sold 50 contracts. I thought time to maybe take a little bit off the table. We've only sort of got a year to go now on these options, and yeah, it's sort of sitting at $9 now, Himax. I'm betting on sort of above $10, but obviously I want it to go much, much higher than that, and that's why the sort of options are doing well. Obviously, this shows you how options can sort of be risky but pay off. I was sort of buying the stock and the options at sort of $6 to $7 Himax, a little bit in the fives as well. But so it's $9. It's up, about 50% from most of those buys, and the options are up 545%. So yeah, they don't always do well, of course. I did just have some Equinox options expire on January the 17th yesterday. Worthless because it was for Equinox going to $10 and it's $5.84. So yeah, that was about £800 entirely lost. I could have put it into the stock and it would have been sort of pretty much at break even, but on the options I lost everything because you're going for this potential upside. So I like the risk and I still like these options, but always good to highlight, where you can lose. Admittedly, that £800 loss I have removed from here because they aren't positions anymore. It's just too complicated to sort of have a running sort of total, including past losses in here. So I've just removed them from here, but thought I would make everyone aware that some of those did expire. And yeah, sort of Riot looking up a little bit this week. Hive looking up. Equinox is down, similarly with Kua Mining as well. But yeah, the sold Himax options went into cash, so I've now got 9,000 in cash. Haven't really seen anything that I wanted to buy. Could end up just buying some stock maybe, possibly even KGHM or something like that, or withdraw it and put it into Trading212. So we'll see. But leave your thoughts in comments below and like and subscribe. See you soon.